Build your dreams, live rich, and leave rich.
Welcome to Live Rich and Leave Rich. You know, our whole goal here is really simple. It's about helping you find financial peace, not just chasing financial wealth. Now, before we jump in, just a quick reminder, everything we discuss here is for your education. Investing always has its risks, so please do make sure you talk to a CBI-registered financial advisor before making any decisions for yourself. Okay, with that said, let's get started. So let me ask you, does your investment portfolio feel a little, well, complicated? I find that a lot of new investors are told they need a large cap fund, then a mid cap fund, and of course, a small cap fund, all just to be properly diversified. And before you know it, you're juggling 3, 4, maybe even 10 different SIPs, trying to figure out where to put your hard-earned money each and every month. You know, this whole process of spreading your money around, it's called asset allocation. But when it gets this complex, it just creates anxiety, which is the absolute opposite of a peaceful financial life. But what if I told you there's a simpler way, a much simpler way? What if you could own the entire Indian stock market? I'm talking from the biggest giants right down to the smallest, scrappiest challengers, all inside a single professionally managed fund? Well, in the next few minutes, I'm going to show you exactly how these amazing all-in-one funds work. And more importantly, how they let you hire a top-tier portfolio manager to perfectly balance that safety and growth for you. Now, to really understand the two main types of these funds, we don't need confusing charts or any financial jargon. Not at all. All we need to do is imagine we're at a grand Indian wedding feast. Trust me, this simple analogy is going to make the difference between a multi-cap and a flexi-cap fund perfectly crystal clear. Okay, so picture this. You sit down at the wedding and a server brings you a traditional fixed thali. This is our multi-cap fund. Now, there's a rule set by the wedding organizer, who in our world is SEBI, and that rule says the server must put a fixed portion of every single dish on your plate. He has no choice. It's disciplined, it's rule-based, and you are absolutely guaranteed a taste of everything. Now, look across the hall. There's a grand buffet. This is our FlexiCap fund. Here, you've got an expert nutritionist with you. That's your fund manager. He looks at all the dishes and has complete freedom to decide what's best for you, right now, today. He might say, you know what, the paneer looks excellent. Let's take a large helping of that. But those fried snacks, they look a bit risky today. Let's maybe avoid them. See the difference? It's completely flexible and driven by expert decisions. So now that we have that big idea in our minds, let's dive a little deeper into the mechanics. To really understand how these funds are built from the ground up, we first need to do a quick recap of the 3 different worlds of companies that live in our Indian stock market. I like to think of the stock market as a vast jungle. First, you have the giant elephants. These are India's top 100 companies. They're massive, they're stable, and they move very steadily. Then you've got the running horses. These are companies ranked from 101 to 250. They're strong, they're fast, and they're growing very quickly. And finally, you have the cheetahs. These are all the companies from rank 251 onwards. They're small, they can move with explosive speed, but they're also much more fragile. And like we said before, trying to manage 3 separate funds to own all these different animals, well, it can be a real headache. All right, let's go back to our fixed thali for a moment and really understand the strict rule that makes it what it is. A few years back, SEBI introduced a very specific, almost mathematical formula that every single multi-cap fund in India has to follow, no exceptions. This is what gives them that disciplined nature we talked about. The rule itself is actually pretty simple to remember. It's 25-25-25. So a multi-cap fund manager is legally forced, they have no choice, to invest a minimum of 25% of the fund's total money into large-cap stocks. Then another 25% must go into mid-caps, and a final 25% must go into small-caps. Just think about that for a second. That means 75% of your portfolio is permanently locked into this fixed structure. The manager only has freedom over that last little 25% of the money. So what does this rule actually mean for you and your money? Well, the big advantage is discipline, for sure. You are guaranteed to always have at least half of your money invested in the exciting, high-growth world of mid- and small-cap companies. But the major drawback is that the manager's hands are tied. If they sense a market crash is coming and they see that small caps are looking really risky, they can't sell them. They must hold on to that 25%. This means the ride can be a bit of a roller coaster, which makes this fund much better suited for aggressive investors who have a very long-term view. Okay, now let's shift gears and head over to the open buffet and see how it creates a completely different experience for you as an investor. You see, in contrast to the rigid rules of a multi-cap, the flexi-cap category was created to give the fund manager what they really value most, a steering wheel, and complete freedom to navigate the market's twists and turns. The rule for a flexi-cap fund, it's incredibly simple.
They just have to invest at least 65% of their money in stocks. That's pretty much it. How they divide that money between large, mid, and small caps is completely up to them. If they feel the market is booming, they can get aggressive with small companies. If they feel a storm is coming, they could move almost everything into the safety of the large cap giants. They have total, absolute freedom.
So how does this actually help you? Let's walk through a real-world scenario. Imagine the market is in a huge bull run and everything is getting a bit overheated, a bit expensive. The fund manager senses that a downturn might be on the horizon. This is just a natural part of what we call the market cycle. So what do? Well, they begin to perform a rebalancing of your portfolio. They start selling the risky small and mid caps, locking in those nice profits, and they move that money into the safety of the giant large cap companies. So when the market does eventually correct itself, your portfolio is better protected, and now the manager is sitting on cash ready to buy great companies at a big discount. That, my friends, is active risk management.
So here's the crucial point, the main takeaway. When you invest in a FlexiCap fund, you are not just buying a basket of stocks. You are hiring an expert. You're paying for their experience, for their entire research team, and for their ability to make those critical decisions on your behalf. Simply put, you are paying for their brain and their steering wheel to navigate the unpredictable roads of the stock market.
So, we've explored the fixed tally, and we've explored the open buffet. We understand the rules and we understand the freedom. Now comes the most important part. Deciding which of these one-fund portfolios is the right path for your personal financial journey.
The choice really boils down to this. Choose a FlexiCap fund if you're a beginner or if you just really value peace of mind. If you want a seasoned expert making the tough calls about when to be aggressive and when to play defense, then the FlexiCap is definitely for you. On the other hand, you should choose a multi-cap fund if you're a highly disciplined investor with a long-term view, say more than 10 years. If you want to force yourself to stay invested in India's smaller companies for that maximum growth potential, then the rule-based approach of a multi-cap is exactly what you need.
Now, before we wrap up, let's just quickly go over a few of those key ideas we talked about. First up was asset allocation. It might sound complicated, but it's really not. It's just the idea of not putting all your eggs in one basket, but spreading your money across different investments to find a good balance between risk and reward.
And then, of course, the star of our show today, the Flexi Cap Fund. Put simply, this is our open buffet option. It's just a mutual fund that gives the manager complete freedom to invest your money in companies of any size, from the biggest elephant to the tiniest cheetah, based on their expert judgment.
We also touched on the market cycle, and this is such a crucial concept. Just like nature has its seasons, summer, winter, monsoon, the stock market has its own natural cycles of ups and downs. A good fund manager, especially in a FlexiCap fund, really understands these cycles and knows when to be cautious and when to be optimistic with your money.
And finally, rebalancing. This is the action that a fund manager takes. So when the market moves up or down, and it causes your portfolio to drift away from its ideal mix, like maybe you have too much risk during a bubble, the manager actively rebalances it. They sell what's gone up and buy what's gone down, bringing your investments right back on course.
So, at the end of the day, whether you choose the disciplined fixed thali or the flexible open buffet, the most important thing is to choose a path that truly aligns with your personality and your long-term goals. Your journey to financial peace, it always starts with clarity, and I really hope this has provided that clarity for you today. Continue your learning, stay curious, and go out there and build the future that you deserve.